Hi guys, welcome to the Didi Talks Money podcast, a podcast where we have real conversations about money, right? I am your host, Afad Tian, and in this first episode, we are going to be talking about US stocks and taxes. So, did you know that when you buy a US stock, your dividends are taxed 30%? So, if you buy a stock and let's say they pay your dividends of $10, what happens is you only get to receive $7 and $3 goes as tax. Now there are some countries, right, like Germany, the UK, that have tax treaties with the US. For these countries, they are very fortunate because with those tax treaties, the taxes are a bit reduced to maybe 10% or non-existent at all. But then for people like us in mostly our African countries, you have Nigeria, Cameroon, in these our African countries, when you invest in US stocks as a non-US citizen, your dividends are being taxed. So I've been thinking of how to go about this, right? Because when you are a big time investor, let's say you have a huge capital, let's say you have 5 to 10 million francs to put in the stock market, that wouldn't really bother you a lot because by the time they pay your dividends, they cut the small they are cutting, you will still see a tangible amount that you are going to get because you have a huge capital. But then I was thinking about small investors like us that we still want to build a portfolio, right? We still want to, maybe every month we are putting our 10-20,000 in the stock market for a number of years to leverage on compounding. How about us? What are we going to do? So I was thinking, and I think this is a way to get around it, right? I think for us small investors that want to be investing consistently small amounts in the stock market, I feel that instead of going for dividend paying stocks, we should go for growth stocks. So our aim of investing will be capital gain and not dividends. Because here is a sweet spot. Capital gains are not taxed. So if you buy a Tesla share today and the price rises tomorrow and you sell, that capital gain that you get is not taxed. But if you were dividend, it's going to be taxed. So I feel that as very, let's say, new investors that don't have a huge capital, I feel that we can just be buying growth stocks. Maybe you buy Tesla, Nvidia, not financial advice. I'm saying stocks that you know can grow, right? Growth stocks. So when you have your capital gain, if it grows, you sell, you make your capital gain, you know there's no tax on it, rather than getting dividends. Because by the time you buy a fractional share of, let's say, maybe $5, and it's not even up to a share, and the Apple is paying maybe $0.23 per share, it will not really make a difference. So I think that's how we can go around it. We focus more on growth stocks. When we have reached a peak and we have huge profits, we sell, take our capital gain, and then go back in the market. So that's what I had for you today. Please like the video, subscribe. There's more coming. Thank you.